Okay, we're getting ready to wrap up the springtime and head into summer of 2024. And it's that time to look into the real estate market, see what's going on, and see what's ahead of us. So not just a real estate market update, but some insights into what we might expect in the near future. Okay, let's start with some good news. So you can see in this chart that our median sales price has been steadily moving up for the past, this is dating back to 2016, so 8 years. And you can see where we topped out in July of 2022 at $380,000 for our median sales price. And this is looking specifically at the 4 primary counties in Northeast Florida, so Duval, St. Johns, Clay, and Nassau counties. And it trickled down a bit over the coming months in 2023, and then came back up here recently to again be at a median sales price of $380,000. So all in all, that's good news. You know, you want the value of real estate to steadily be moving up. But let's take a little bit deeper dive into what's happening here. With the combination of higher mortgage interest rates than we've seen in recent history and what is now rising inventory, I'm anticipating that what we saw for rising prices will stabilize to slow down toward the end of this year into 2025. And here's why. You can look at, this is an active inventory chart, again, in the 4 primary counties in Northeast Florida, where we saw this sharp decline in 2020 that we just didn't have enough to sell to people. And that pushed prices up, so this is a supply and demand thing. So as prices went up, you can see inventory start to climb again. And it got back to what was over the past 8 years, sort of the normal level. And then we've jumped above that to where we have total active inventory right now of 7,947 listings at the end of April in 2024. And so again, thinking about this from a supply and demand perspective, let's look at what that might mean for near-term price either increases or decreases in the value of residential real estate locally. To take the conversation a step further, let's look at new pending sales in Northeast Florida. And we talked about how inventory had hit an 8-year high. So that's part of the equation, but what if we're still selling more houses? And so even though we have more available, we're also selling more houses, and therefore that balances out. Well, that's not quite the case. So we'll look at this chart here, and you can see that new pending sales, and to be clear, this is not closed transactions. So we're not talking about people sitting at a closing table trading money for keys. We're talking about a contract has been signed to purchase a house. But if anything, the actual number or relationship between new pending sales and closings is slightly fewer for closings, because something could happen before the deal is done to where the deal falls apart, but we're not going to have a higher number than this, which is why I like taking a look at this number for near-term impact to the real estate market. And so we can see that in April of this year, there were 2,119 new pending sales in that month, which, comparing it year over year, is down 15.7%. So we see inventory that has gone up recently, but new pending sales that have gone down recently, which will ultimately mean a market where things are beginning to slow on average. Now, let me add a little bit of flavor to that statement. And there are still areas and still price points where this relationship does not look the same as it does for the Northeast Florida area as a whole. So we may still have pockets of our market, particular neighborhoods, particular price points, where when we do a deep dive, there's still a very strong relationship between new pending sales and inventory that is either falling or just hasn't climbed in recent months and years. And so that's something where I, if you're talking about your house specifically, would have to do a deeper dive to say, hey, this is what the market's doing at large, but when we look down into it, that's not really the case for what you own or what you're looking to purchase. To round out the conversation on what the market is doing presently and where it's headed, we can't neglect to talk about mortgage interest rates. This is a Federal Reserve chart on the 30-year fixed rate mortgage over the past 50 years, basically. And what you'll see, and I'll actually do a quick click and change of screen here, per tradingeconomics.com, the 30-year fixed rate mortgage has averaged almost 7.75% over the past 50 years. Back to our chart. You can see where between 1970 basically and essentially 2001, we didn't really see a mortgage interest rate below 7%. There were a couple blips where for a month or maybe two, it dipped just barely below 7%. Outside of that, it was above that number for the entire period of time. And then we got into this stage where we saw below historic average mortgage interest rates for almost 2 decades, and then extremely below that average for the period from 2020 to 2022. And so what I think, and no one has a crystal ball, but as long as the Fed is trying to fight inflation and the Fed funds rate stays where it is, even close to where it is, even if they were to reduce it slightly, we will probably see mortgage interest rates somewhere in the 6 to 7% range. That's historically where they've been. So I think as people have become accustomed to that, there's still demand for real estate. And really the kicker will be if we continue to see inventory rise in our marketplace, more homes coming on the market, pending sales staying flat or declining, that's when we could start to see prices that actually come down. But this takes time. The real estate market is like a large ship. You can't turn it on a dime. You have to turn it slowly. And so we will see this coming if it's going to happen. Prices declining, that is. And the thing to keep an eye on is this relationship too between the Fed funds rate, mortgage interest rates, and if we see mortgage interest rates get up into the 8+% range, I've seen just firsthand that people will start shutting down their decision to make a move. If it gets down below 6%, my bet is we see people that flood the market because that gap, whether they have a 3-4% interest rate on their current home, if they're going from 4 to 6, they don't mind, it seems like, the average American consumer. But if they're going from 3 to 8, that's a pretty big gap to cover. And so it's less likely that people are willing to do that. So that's my update and insights into our market as we head into the summer of 2024. If you've got any questions, I love chatting about this stuff. Feel free to call, text, or email 904-405-1995 and Jeff@pursuitrealestate.com. Take care.